All right, so Starbucks just dropped the first big report card for its massive turnaround plan, but do the numbers actually tell a good story? Today, we're going to dive deep into their latest earnings report to see if this whole back to Starbucks strategy is really brewing up some success. Let's get right into it.
Okay, so right off the bat, here's the big mystery of this whole report. It's kind of a tale of two cities. On one hand, Starbucks sold way more coffee than anyone thought possible. We're talking they beat the forecasts by nearly $300 million. But on the other hand, they actually made less profit than Wall Street was betting on. More sales, less profit. How does that happen? That's the central question we're going to unpack today. And to get to the bottom of it, we're going to break this down into 4 simple parts. First, the overall report card on their turnaround plan. Then, we'll get into the good news. Customers are coming back. After that, the bad news, why their profits are getting squeezed so tight. And finally, we'll look at their 3-part plan to fix it all.
So let's kick things off with the big picture, the report card. You see, this quarter's results are really the first major test of their whole back to Starbucks plan. This huge effort to get back to what made them great and win customers back over. You know, what's so interesting is this quote from the CEO, Brian Niccol. It pretty much sums up their entire game plan. It's simple, right? Get people walking through the door and spending money first. That's the top line. And then worry about making a bigger profit on each sale later. And as we're about to see, these numbers show that phase 1 of that plan, it's definitely in motion. All right, now for the good news. And honestly, this is where the story gets really exciting for Starbucks. Their top line, which is just a fancy way of saying total sales, is showing some seriously impressive signs of life. The headline number is a massive $9.9 billion in revenue for just one quarter. That's a solid 5.5% jump from last year, and like we said, it blew past what experts were expecting. This tells you one thing very clearly. People are absolutely spending more money at Starbucks. The first part of that CEO's plan? Check. A clear success. And it's not just random people stopping by. Their most loyal customers, the diehards, are more hooked than ever. They hit a new record, 35.5 million active members in their rewards program. Now, that's a super important number because it shows their dedicated fan base isn't just sticking around, it's actually growing. But this right here might be the real showstopper. For the first time in 8 quarters, that's 2 full years, you guys, the total number of transactions in the US actually went up. After years of that number going down, more people are physically walking into a Starbucks and buying something. This is maybe the single biggest sign that a real turnaround is actually taking hold. So how'd they do it? Well, it wasn't just one magic trick. They really focused on improving the service you get in the store. That's their Green Apron stuff. They totally changed up their marketing and menu, which led to a record-breaking holiday season. And really, critically, they managed to bring back both their loyal rewards members and the more casual drop-in customers. So, customers are back, sales are way up, everything's perfect, right? Well, not so fast. Let's flip the coin and talk about the tough part of the story, the profits. This is where all that great news about sales hits a bit of a wall. Now, to really get this, we gotta quickly talk about a key term, operating margin. Just think of it like this. If revenue is the gas you put in your car, operating margin is how efficiently your engine burns that gas. It tells you how much profit you squeeze out of every single dollar in sales. A higher margin? That means a more efficient, more profitable company. And this chart really shows the problem perfectly. In North America, which is Starbucks' biggest market by far, that engine efficiency has dropped off a cliff. Last year, for every dollar they made in sales, they kept about 14 cents as profit. This year, it's down to just 10 cents. That is a huge hit to their bottom line, even with more people buying coffee. So what's causing the squeeze? Well, it's basically 3 things. First, the turnaround plan itself costs money, a lot of money up front, to invest in better service and nicer stores. Second, the cost of their products and just getting them to the stores is up. And third, they're getting hammered by inflation like everyone else, especially from things like tariffs and the rising price of coffee beans. So, all of this brings us to the final and I'd say most important part, the future. They know what the problem is, so what's Starbucks' actual plan to fix it and get those profits growing again? Turns out they've laid out a pretty clear 3-part strategy. Okay, so what's the game plan? It's basically a 3-pronged attack. First,
They're shaking things up in China, creating a joint venture. This is smart. It lets them grow faster in a massive market while sharing the huge costs and risks with a local partner. Second, they've launched this massive $2 billion savings plan to make the whole business more efficient, from their supply chain all the way down to how the stores operate. And third, they are doubling down on tech. They just hired a new chief technology officer from Amazon to completely supercharge their app and digital menu. That's a huge signal that they know the future of coffee is just as much about the app as it is about the barista.
But, the company is also being pretty honest and realistic about this whole thing. The CEO himself came out and said he doesn't expect this turnaround to be a straight line pointing up. He's basically telling everyone, hey, there are gonna be ups and downs and we'll have to adjust as we go. It's a very clear sign that this is a long-term project, not a quick fix. So here's what it all boils down to. Starbucks is taking a hit on its profits right now on purpose to invest in a much bigger comeback down the road. It's a classic case of short-term pain for long-term gain. The plan is clearly working to get customers in the door, but that profit recovery, that's still a work in progress, which leaves us with the big question. Are you convinced enough to buy their coffee, or maybe to buy their stock?